Okay, so ladies and gentlemen, welcome to episode 25. And there you go. If you didn't catch it, there is a disclaimer that Mace's wife could give birth at any moment. So Mace may just run away. We don't know. We'll be interested to see. But for everybody out there, welcome back for episode 25 with Jason Smith, who's the director of partnership development at Figure, where he basically lives at the intersection of bleeding edge fintech, capital markets, and the future of mortgage rails. He's one of those guys who can take a wildly complicated crypto blockchain infra concept, somehow make it feel obvious, sane, and like it should have always existed. He's worked across the mortgage innovation for years, connects the dots between lenders, investors, and infrastructure better than almost anyone, and is obsessed with how to modernize housing finance without making it weird or hype bro tech. He's sharp, fast, practical, and you're going to see why people in the industry call him dangerously likable.
Wow.
There you go, Jason. That was written by ChatGPT, by the way.
I thought you tapped into my personal ChatGPT because I created one just specifically to make me sound cool.
There you go.
And you did there. Now I wasted all that time. I should have just emailed you.
Apparently, OpenAI just stole that information and provided it right on over to us.
Boy, they suck up well. I like it. I'll do the 20 a month now. Done.
They are quite the sycophant. All right, Jason, we always really start this out as like nobody is a little kid, except for Lindsay Meyer, wanted to be in mortgage or mortgage tech as a little kid. So first and foremost, what did you want to be when you grew up, when you were a little kid?
I always wanted to be a fighter pilot. I was a jet head when I was a kid. My walls were covered with different fighter airplanes, things like that. I wanted to fly an F-15, if I'm going to be specific about it.
Right.
It obviously didn't work out because here I am. But no, that was my dream. I always thought it was cool. I wanted to be part of something bigger than me, help out. I come from a line of my father, grandfather, and my uncle, and we're all in the military for at least some part of time. So it was my thing until it wasn't my thing.
So what went wrong? How did it not become your thing?
Well, where do we begin? It all started at birth. No, actually, it was. Sorry, no, it was. It's a simple yet sad tale. I was actually in high school. I had a congressional nomination to the Air Force Academy, and then the first weekend of my senior year of high school, my left lung collapsed as I was working as a bagger at a local grocery store chain in St. Louis on a Sunday morning. Yeah. I ended up being in the hospital with Fisher-Price, my first chest tube for a week. And surprisingly, after that, the Air Force Academy said, thanks, but no thanks. We're going to medically disqualify you. And,
oh, man.
I moved on. Turns out, I grew to 6'5". So I went well beyond the cap of pilots. So I probably would have been scraping bird poop off of a runway in Guam or something.
Oh, right. Because you would have been too tall to actually fit into the jets themselves. Right. Okay.
Exactly.
I never really thought about that. Okay. You win for the craziest story, I think, ever so far of your entire career trajectory changing because of a collapsed lung.
Well, what's funny is a spontaneous pneumothorax is actually not that uncommon for teenage boys about that age. It happened to me too.
Nice.
Oh, really?
Yeah, look at you knowing the official term. I know. They told me when asked, they said, what causes it? They said, it is prevalent in tall, slender white males. I was like, great. I need to get fat, change ethnicity, and maybe a little bit of sex with her to get out of it. But
it's all possible nowadays.
I'm fat and short. It works out well for me.
Yeah, who knew I was that far ahead of the game? But it actually happened much more mild amount, I guess. Almost a year later to the date, my first week of my freshman year of college. So thankfully I did get older and I got fatter. So here I am with two good lungs.
Two good lungs now.
Yeah.
All right. So how did you end up in the mortgage industry, Jason? What was the catalyst?
That was it was actually a friend of mine. I was in between things many years ago, and I was delivering pizzas for Domino's Pizza. I'd worked as them before as a manager, and short story long, friend of mine there, their family owned an appraisal company. They worked with a lot of folks. This would have been the early 2000s, like 01 to 03. They worked with, obviously, with a lot of people in the industry, and I got to know my friend's mom, and she just one day, she goes, Jason, you have the gift of gab. You should be a loan officer. And I looked at her, I go, what the hell is a loan officer? About 6-8 months later, I was at my first job at this very small local broker that ironically was right across the street from the Domino's I worked at in beautiful and historic Overland, Missouri, where I am from. There was one computer in the whole thing, and no one was allowed to touch it, so they didn't bugger up the files. And I learned a lot. Closed one loan. Learned a little. Learned a lot, depending on how you look at it. And never quite looked back from there. For some reason, stuck with it for over 20 years now.
So now, how long were you a loan officer for?
03 to 08, 09. Probably 6-7 years until it was. I pushed my way through the crash, and then kind of got to the point to where I was almost sick of places closing around me. So I tried to get out of the industry, as most of us do. For 2 months, that didn't last. Went back to work for another, and just pieced my way through there. And when I stopped being a loan officer, I actually took a job for Bank of America at a fulfillment site, and it was rightfully so. I was exceptionally overqualified for this exceptionally entry level position, but it got me on the path to where I am now. So kudos to them, and I worked with a ton of great people. But recovering loan officer is what I still refer to myself.
There are a lot of recovering loan officers in the industry who've gone on to do pretty great things. Kevin Peranio, Brian View, and Jason Smith. Okay, so now you're at Figure. So before we talk about Figure, Director of Partnership Development, what does that mean? What is it that Jason does besides record great videos?
I was just going to say, you made like meatloaf and took the words right out of my mouth. No, God, it's not often you get to use meatloaf in a sentence, but not talking about diners anyway. But no, it was what I do there is it's really interesting. When I was first referred to the job, and what's funny, it was Brian View actually that you mentioned connected me with a person that I used to work with here, and I probably would have looked past the job posting just because it didn't seem like on the surface something that I had historically done. But after talking with them, it's really what my job is in a nutshell is I work exclusively with banks and credit unions. And it's really to get them to partner with us, to leverage Figure's technology, leverage Figure's product to help complement their existing offerings and help them meet a market. And so it's really just getting people to literally partner with us. And go from there. So it's kind of a sales job. It's kind of a partnership development job. It's a relationship based, but it's also very much a partnership because there's a lot of ebb and flow with that. The way that Figure is structured as a company, it benefits us as a company almost as much sometimes as it benefits the partner, and other ways around as well. So it's a lot of fun. I like it, and I'm not just saying that because I'm live and I'm wearing the t-shirt.
Well, no, I was going to say before you go any further, though, can you speak to what Figure does as if I have no idea what you do? Because I did, for those who don't know, my wife is 40 weeks pregnant, and so it's not a lot of time. So I connected with you on LinkedIn about 1 minute before our interview and looked up Figure. So
I appreciate that. You know what? I like to maximize my time opportunities as well. But no, what Figure does is we are a an all digital automated HELOC provider. We work in the home equity space. And there is actually the company itself started out as a consumer direct lender, as a fintech first. We're all about the technology, consumer direct lender. And then we've expanded out over the last, started out in 2018. And then after a year or so, we started expanding out to partnerships, which is really working with IMBs primarily at first, allowing them to leverage our product and our technology, because really what it is, and it's expanded from there now beyond so many things, but really getting back to the product itself, what makes it so great and so different than other home equity products out there is, one, the product itself is kind of a hybrid. I like to call it, it takes the best parts of a closed fixed rate closed end second and a HELOC, puts them together. And then also what it is you sit down, you start the process on your computer, you finish it in that same seating, and you're done. You can meet with an e-notary right then. I feel like the guy from the 80s commercial, the Remington razors, where he goes, I like the razors so much, I bought the company. I just bought a couple shares. I don't actually own the company, but I'm actually a customer of Figure as well. And it's really great. I think that's what's different, is it creates the experience that so many folks in the market are looking for, because they have good credit, they have good income, they have good equity. And in today's modern world with the technology that's out there, they expect a Visa MasterCard experience. Like, hey, I log in, I put in my information, you do your verifications, we're moving down the road with an approval, and I get my funds. Unfortunately, that's not the way most of the market goes in home equity, because historically it's kind of been a byproduct, and hasn't even been directly related to mortgage when it comes to most depositories. It's been on their consumer lending side. So really that's what Figure does, is it has perfected that process. And it's not for every loan, but it is for every lender that's out there. But the actual experience and the technology is fantastic. I mean, it is, as a person that's been in technology sales for at least a dozen years now, it is really cool selling or shilling for a product that is, one, exactly what it says it is, and is, two, is just fantastic. And I said, as a person that pays a monthly payment to Figure now, and I went through the experience, and it was easy breezy.
But you said that you partner with, okay, so how does that navigate that for me? So Figure actually does lending, but then you also can partner with Figure as technically would be competitor.
Technically, yes. Technically, it is a competitor. So let me give you like the 20-second background. And when I say 20 seconds, it's probably 3 minutes, but I'll do my best. 20 seconds. Figure itself, what makes us unique in the space, and especially amongst our competitors that are starting to come out there a little bit more. One is the technology. No one beats us in the time and the technology, and that's consistent across the board. It's not a 1 in 10. It's not like you're getting a sales job and they're like, oh yeah, the sales rep make 300,000. You're like, that's one dude out of 200. This is all of them. It goes through that. But what makes Figure unique from the product and tech itself is that our company is divided into basically two halves. The one half is the origination side, the lending side, which I'm on. The other is our secondary marketplace that we call Figure Connect. Yeah. And really, we've created a marketplace where our loans can be sold similar to, think a Fannie or Freddie, except for non-QM and for our loans. And so what it does is it gives the opportunity for our partners to leverage our technology. We have a white labeled experience, so they can log in, they can leverage it as to their customers, to their members, to whoever. They don't know it's anything but the bank or the entity they're dealing with. But then that lender has the ability to hold on to that asset. They can service that asset, or they can sell it and make spread in our marketplace, which typically hasn't been the case. I mean, that's one of the reasons why consumer lending has been kind of tight knit in the home equity the way it has been, because there really hasn't been a robust or profitable market for it, which has limited the lending. It's limited balance sheets on it. It's limited the size of loans, quite honestly, and it's limited the products as well. But what it does is basically our partners, when I talk to somebody, they go, hey, yeah, we want to do this. We're going to fast forward through the sales and partnership process. What they do then is they get an instance of our platform that they can either drive folks in, their customers in, can self-serve it, or they can start out with the loan officer, with an originator, something like that, and the borrower comes in. they're going through our technology the same as if, say, somebody went to figure.com on their own. They're going through our technology. They're getting the verifications. They're getting an approval in 2 minutes. And then they're going through the process and they can close a loan. And then we have our different partnerships where we're either going to, that loan, we're going to keep it. It's going to close and fund in our name. We pay out a percentage, or that's going to close and fund in our partner's name. And then it's up to the partner what they want to do with it. If they want to hold on, maintain that asset, if they want to service it, things like that, they can. If they want to pool it together and sell them every couple of weeks, if they want to participate in our securitization, something like that. So it creates a lot of, it's not just another product for them to sell, although it is, but they're really selling the experience, and then they're selling the ability of that financial institution to be able to leverage multiple things after that loan is closed. So it's more than just a sort of an exchange of services and goods and money. It becomes an asset that they can build their balance sheet off of, or unload if they want.
Quick question, Jason. I'll go first.
No, go ahead.
I was just going to say, what's the biggest pushback you get with those credit unions and community banks? Like, if it's, my point of view is it's a no-brainer, but I'm sure it doesn't feel like that for everybody. So I guess, like, what's the pushback that you get from those folks?
Yeah, no, that's a great question, and I think it's a no-brainer as well. I wish I could just make that in my entire sales cycle. But I would say that the two biggest things are, one, our product is unique in that it is fully drawn at closing and funding. So it's not a traditional HELOC in the aspect of, you're not opening a line of credit. As Chris Rock says, it's insurance in case something happens. It's not that. We don't have an interest only period. It cracks me up. It's the only part of the industry where we're still cool with an interest only payment. And they're like, not for 3 years, but go ahead and do that for 10 and you'll be cool. We don't have that. Ours is a fully amortized principal and interest payment, and then it's fully drawn at closing. So it's a very purpose-driven loan. So the first thing is kind of getting them over the hump that, hey, this is something folks want, because no one's touching their first mortgage for a cash out, for a debt consolidation, different things like that. And our average loan size is up above $90,000 now across all of our partners. So it's a big balance to just be paying interest on over the next decade. The other part of that, and it goes more with the depository space with banks and credit unions specifically, is that one of two things. It's a bit of a pride thing, as well as it's a bit of a, we don't need that. So one, it's been their space forever, because that's typically or historically where you've gone for home equity loans, is to a depository, because they hold it on their balance sheets. And the other thing is not realizing how much of the market actually wants that type of loan. I've had conversations. It's really funny. We use Plaid. Our integration with Plaid is our easiest and quickest and first stop to verifying income, which takes about 4 to 6 minutes all told. And Plaid gave us some data, and it's really interesting because they're obviously tracking where the accounts are at that they're verifying the information. And there were, over the last 2 years, there have been almost 222,000 credit union members that have applied for figure loans that have not applied for those figure loans at that credit union, because we would know that they would be a member of ours. So that's the biggest hump, is that it's one, it's understanding the need for the product, but then two, understanding that it's a complement. It's something that you can add in, and it's not us saying, hey, you know how to do this, we're going to show you how to do it better, or we know how to do it better. What I say is, what we're giving you is an avenue for this segment of the market that expects this kind of experience. They expect this kind of ease and speed. And if you don't have it, they're going to go somewhere else because they have. And then we're just going to verify the deposit accounts with your bank or your credit union, and they're going to do that loan with somebody else. And it's also where I think why we're seeing, there was an article recently that IMBs are really taking big chunks of the home equity space over the last year or two. And that should be a real threat to depositories out there, because that's been their home field for forever.
I have a million questions.
Fire away. The caffeine's kicking in now, so the answers are only going to get
Well,
higher.
I'm like, I don't know if I want to go securitization. Okay, so let's start. So it is. I mean, obviously, Cagney is so fun, right? Like, so this is figure to me. What is going on, PK? There's like all this weird noise.
We can
Anyways,
hear all the stuff around you, PK.
so anyways, so obviously Cagney started SoFi. Figure to me is very SoFi-esque, if you will, right? Obviously SoFi's, changed since he's left, but what is it? I mean, everything is automated underwriting, right? Within the platform itself. So if I remember correctly, there is really no human touch. I assume you're pulling in AVM data automatically. You're doing the check via Plaid for income and employment. I mean, this is like a SoFi personal loan type experience where I can pull up the Figure website after this call if I want and apply for a HELOC. And it's fairly instant, like in terms of the approval. Do I have that correct?
Yeah. No, you're spot on. It takes about. I always say it takes about. I guess I think that sounds more warming, but it is 12 pieces of information that you put in there, and we'll give you what we call an offer, but the industry think a pre-approval, and you put that information in there, and it's typically what you would see as a contact sheet or contact form on a depository website. Except for we're not asking for the social security number. But yes, what we're doing there is we're instantly pulling an AVM. We're pulling a soft credit pull via Experian V9. That's exclusively where we get our credit from, even the hard pull. So if you're like somebody like me or so many others, it's actually kind of convenient because you only have to unlock one credit bureau. But we're pulling an AVM. We're pulling the credit bureau. And then we're using typically our proprietary data to verify liens based on information we have, bouncing that up against liabilities. We're also doing a vesting search if we have, and if we can't verify any of that information, we'll pull an instant title right then and bring that in. So right up front, we are getting their value. As long as the loan amount is $400,000 or less, that's the only thing we need for the value. That box is checked. We have the AVM. We're getting their credit, and then we are verifying the lien to make sure what position we're in, because we do first, second, and third lien position. And then we show the borrower what they get approved for. The one question we don't ask is how much they want in a loan, which is very standard. And I think that's where it gets very confusing and very limiting for people. I think sometimes, if I can do a quick side note, I think the problem a lot of times with a lot of home equity lending and consumer lending is that it's almost like going to the Cheesecake Factory. There's a lot of good stuff in there, but there's so many options, you don't even know where to start and what to do. And if you've never been to a Cheesecake Factory before, you're almost overwhelmed, which means, it takes 3 cocktails to get through the menu, which is fine too. But when it comes to lending, when somebody gets on the website, if it's not what they do or know, I think most people are already coming in from a position of, I hope I get this. Even if I know my credit's 780, my income's good, I have the equity, I don't know what the crap any of this is. I'm just hoping I get what I need. So they'll put in a small amount, or they'll think, oh, well, that's a little amount. What's cool about our process is that we get that information, and then we spit out an offer, and that offer is the maximum amount that we will lend you. So if you're thinking, hey, I really only need 40, well, we can actually lend you based on your value, based on your credit score, and based on the income that you've put for your household so far. This is what we can approve you for. And then it's up to that borrower, that consumer can just take this little bar and they can lower it down to wherever they actually want that. So for originators, it is, it could easily be said that it's a very good upsell tool, so to speak. But what it also creates is a lot more opportunity for that borrower to take care of stuff that they need. They're like, okay, I need 30 grand to do this work around my house or do this addition, but I need that because I have 40 grand in credit card debt and I don't want to add to it, but I'd love to pay both of those off. They're typically going to go into an application at their credit union or their bank's website and go, just thinking about the 30,000, because that's what I really need. What we create is the opportunity for them to see beyond that. They can pay off debts and things like that, but they get more opportunity. And this is all happening in minutes. And that's not a joke. The 12 pieces of information, I always tell people it takes about 2 minutes if you're putting in somebody else's info. If I'm putting in mine, it probably takes about 35.5 seconds to do. Takes a system about 30 seconds to process everything. And boom, you get an approval. You see exactly what the payment is, what the payment choices are. If you want to pay an origination fee to buy your rate down, you can do that. You can choose a term. We have terms from 10 to 30 years. We're only going to show you terms that you're approved for. So if your DTI is a little tight, we're obviously not going to show you a 10 and just piss you off. We're going to show you exactly what you get. The fees are lined up right there, which the fees are fairly non-existent. If there's a random, say, recording fee, or if it's some place where we have to do a manual notary, there's going to be a minor fee with that. But then that's it. And the dollar amount that they see for their loan is exactly what they get deposited into their account after that loan funds. There's no I wonder, there's no redisclosure, there's no sort of teaser amount, anything like that. And that's really where we can help all of these depositories really get out in front of that segment of the market that's going elsewhere to other companies that are leveraging the technology that we have. But that's what makes the product so great. And then you sit down and you start. I mean, in this same seat I am here, except for the screen that's right there, I use that. I sat down, I started, and I timed it out. And it was about 27 minutes done. 27 minutes done, and I had met with the notary, which I thought was going to be a massive pain in the butt. And it took about 55 seconds. I thought he was trying to blow me off. He was just trying to move on and let me live my day. But it was easy. And that's really what we excel at, is that.
So how long from application to funding?
Application to funding, if it is an owner-occupied property where we have to account for a 3-day rescission period, 5 days. I started mine on I'm trying to think, because I had to go back to my recovering loan officer. I'm like, wait a minute, Saturday counts as a rescission day. I think I closed mine on Wednesday evening at probably 6 o'clock, and it funded on Monday.
Damn.
They were wired in my account. It's fantastic. I think I did the day number right. Yeah, it's great, because really the thing is that funding, obviously we all play by the same rules. If you're in Texas, you have to have a 12-day cooling off period. Most of the country, if it's an owner-occupied, I would imagine all the country, you have the 3-day rescission period. But really the race is getting to that part that you can't control. And the reality is I started with a company that does HELOCs. That was a top 10 HELOC lender. I don't believe they do them anymore since they were purchased by a large credit card company. I'm not going to name any names, though. I started with them in the ass. It went on for so long. I got a new job with Figure, and I'm sitting here going, you don't need this. We don't need this. And I finally told them, I said, I feel like it was easier to buy my house times more than I'm looking for in this line of credit than it is to get this line of credit. And BT Dub, Chase just sent me a credit card for 75% of the balance I'm looking for here by just running my credit income that I said and looking at my payment history and go, he's a pretty good guy. Let's see if he can rack up some debt. And that's really where the disconnect is in the industry, is that those of us that are looking for this type of loan and this type of experience expect this type of loan and experience. But what's happening more than not is we're running up against companies that we know and trust, and we have deep relationships with, like the one I started with. And you're like, what the hell? What am I doing? This isn't rocket science. This is easy. It's a collateralized loan. Going back to the SoFi thing, it's very similar to that, except for this is obviously in the collateralized space, which makes it more appealing from a rate perspective, from an overall term and things like that. But it's shocking how much of our industry is still so behind in this. But the ones you see that are moving like their asses are on fire are the IMBs. The IMBs that didn't have this before, they're looking for alternatives, ways to help their clients and their book of business, and how to do it in the way that people like them to do it, which is quick, efficient, no nonsense, let's get it done.
Right.
That's why they love us.
So let's talk about DSCRs,
Yes,
because that's a new product for you guys, right?
it is. It is. And you're going to rapidly run up to my knowledge of that, but I will do my best to fake it like I do conversations about hockey.
So, so for folks that I mean, I think I've mentioned this before, but I came from the capital markets securitization world, right? That's why I said, I also want to talk about your guys' shelf. But yeah, I mean, how is that product? So for those who are watching who don't know, a DSCR loan is debt service coverage ratio loan, and is effectively for investment properties. Most of them are closed in LLCs, and it is basically a calculation that's based on the rent of the if I have this correct, it's the rent of the property against the debt that's actually being brought in. So way less compliance restrictions on this type of loan. So is the DSCR experience somewhat similar to the HELOC experience, or what does that kind of look like?
No, it is. It's very similar in that it all starts out the same way, and as much that can be automated is with the DSCR product, and it is a very new product for us. It's something that it takes a couple of extra days for that to close typically, just because those extra verifications need to be done, and you have the verification of the property, the income, the various things like that you're really leveraging in lieu of qualifying that borrower based on their overall income as if it were a primary mortgage for them. So yes, that will continue to improve. The last I heard, I think we're at an average about 5 days or less for those to close,
That's
which
fast.
it is. And it is something we're rolling out. We're rolling out slowly. I think that's what, one of the things I like about the company is that, one, we're not looking to, at least initially, create tons of new products. What we're looking for is how can we take our core products and how can we continue to expand and make those better and make those available to more people? Because to your point earlier, we don't employ any underwriters. It was the first kind of, to me, when I started here, when I found that out, we don't employ any underwriters. So we don't make exception-based approvals. We're not manually underwriting anything. If you have a self-employed borrower with tons of schedules, we're not going, okay, well, this one, yeah, we can work this back in, we can do all that. No, that borrower is typically not going to be our jam. But what we've done with that is we found a way to now leverage business bank statements for income verification. So we don't have the ability to manually go through all these things because it's just not how our process is built. But what we try to do is deepen our bench, if you will, on the products that we already have. And DSCR is one of those that kind of came out of the fact that our traditional, our sort of flagship HELOC product, we will do that on second homes and investment properties. Now, the caveat with that is we're looking for more like your neighborhood or next door neighbor investor, that has a few properties or something. We're not really looking for the guy that, the person that has 20, 25 properties, operates an LLC.
Right.
And so we looked at that and we go, okay, well, what can we build within that to help address that market, but that we can still work within the technology that we use and the lack of underwriters and personnel to look at that. And that's where we came up with the DSCR. And we're right now, it might not be as quick as we're going to get to it. It's still infinitely quicker than I would imagine anyone else out there. And it's only going to continue to improve those times as we catch up the technology to that. And we have a piggyback HELOC as well that kind of works the same way.
And it's brilliant, really, at the end of the day, because for like a lot of like credit unions or community banks, right? Like doing a DSCR loan, like you don't have huge need. Like there's not enough of a need to have the full infrastructure because it is a totally different, loan type. And you have to, I mean, underwriting it, from a manual standpoint is very, very different, right? So you've got like have staff that are specifically for that. And the other thing is on DSCRs, the highest risk is typically LLC fraud, right? So what I love is you guys are saying, okay, we'll capture, and I'm just making up numbers, but 60% of the DSCR market where it makes sense, just like you do on the HELOC, where it's like you're probably capturing 80% or could capture 80% of the HELOC, rather than trying to say, oh, I'm going to do everything and then making it near impossible to actually build out for every single edge case from that perspective.
Yeah, that's exactly it, and that's what I like. It's sort of a defined aggressiveness, if you will, where we're not trying to be the end all be all for everyone, but we're trying to improve on what we have, but also looking forward and where the market's at. And you're exactly right. We can potentially capture a big market, a big segment of the DSCR. But more importantly, we can capture that for those institutions, particularly depositories, that don't have the structure for that. They don't have the experience with that. But it's really surprising how many people sort of bring it up. I honestly, when I meet with a bank or credit union, I sort of bring it in after the fact. After I go through everything, I joke with folks that we're not a one-trick pony. We're like a 1.5 trick pony. And that's really what that is. And that's too, I try to, because we don't, getting back to the earlier part of the conversation, and maybe one of the things that I think potentially worries some of the depositories, especially credit unions, which are built on their relationships, is the worry that, okay, I'm going to go through this. And even if I close that loan in my name, I hold on to the asset. Figure has all this information because everything's going through their platform. So see, the lender, the bank, the credit union does zero fulfillment. There's zero processing, underwriting on their side. They're not doing the disclosures. They're not doing the closing, any of that. So the fear is that, okay, you have all of this. My member, my customer suddenly is at risk to me. And the reality is they're not. We make that guarantee. We do not market our partners, clients, borrowers, members. And I say for two reasons. One, because it's just terrible business. And the other thing too is that we can't give them anything they don't already have.
Right. Yeah.
But it makes zero fiscal sense for us. And in, I think, $19 billion of lending that we've done so far across our organization and our partners, we haven't had one occasion where we have gone out and we have marketed one of our partners' clients or borrowers.
It would just,
Jason, Andrew, what are you going to say? Jason, so quick question. So, and you can correct me if I'm wrong on this, but today you have, mortgage companies that are built around, you have Fannie, Freddie, and then you have, your LOS system, your pricing engine, point of sale, et cetera. From what I understand, Figure is all of that. You use the word Rails, top of the conversation. And so theoretically, as you guys expand, you guys have HELOC now, DSCR. My assumption is in 5 to 10 years, maybe you have a whole bunch of other products, and who knows, in 15 years. Theoretically, you could, build mortgage companies on top of Figure's platform, Figure being like the underlying platform. You kind of see this in the credit card space where you have these credit cards that pop up, Ramp is an example, Brex is an example, where the underlying bank is something else, but these are companies, are software companies built on top of underlying, older, I guess, infrastructures like community banks. So theoretically, something like that could happen with what you guys are building. Is that kind of the vision? How much of that is true, or how much of that is, I guess, like hopeful thinking?
Well, first of all, I believe this is when the disclaimer should go up that the views expressed by Jason Smith are not necessarily those of Figure and its board members. We are a publicly traded company now, as of September 11th. But no, I think to your question, that's a great question, and I get that a lot. And our CEO, Michael Tenenbaum, he is really good about that, and he's really good about delivering the vision. And I think that helps a ton, especially with a lot of the partners that I work with, because they're larger banks and credit unions, and they want to know where we're going, because they don't want to just invest in a partnership for the next 6 to 12 months or to get them through some certain hump or something. They want to know where we're going. So we get a lot of conversations with that. I think the primary focus that we're going to see is potentially an expansion on our secondary market, our Figure Connect. It's to really expand that out to be a marketplace for other assets that banks and credit unions hold on to that they don't necessarily have a place or an avenue to exchange those, to sell those, different things like that. I think we're going to see some continual progression into the blockchain space because our blockchain really helps us save a ton of money after the loan funds because it's all on basically a digital ledger. And so there isn't paper documentation and verifications that have to constantly travel with each of those files. I think the expansion of the product, see it some, there's been some talk about, potentially getting into something more of the traditional first mortgage space, if you will, and not just a first lien HELOC. I don't know as if, and speaking just on what I know, I don't know as if that is in the short to midterm future for us. I know as far as standing other folks up, our primary focus is on one, we have our consumer direct team, which does an awesome job. They're going to stay, they're going to keep doing that. And our focus really right now is on banks and credit unions primarily. We've had a lot of good relationships and continue to build those in the IMB space, but it's really partnering with those banks and credit unions. And I would imagine, and this is probably the safeguard or political answer on this, I would imagine as those relationships continue to grow and get larger, that's going to drive a lot of our future enhancements and potential products and things that we're doing. But as of right now, we're focusing on being the best at what we do now, and then deepening that field around that, and potentially creating a secondary market space that rivals a Fannie or a Freddie. Because I think that's, going back to Mike Cagney as well. I think that's one of his big thoughts is, we need to create more competition. We need to create something else for the industry to be able to partake in, to be able to leverage into, and it not just be, as much as I love non-QM lenders, I absolutely love it. Like I said, I'm a recovering loan officer from the early 2000s. So I get that non-QM is not what so much we saw there, but what it is, it's non-traditional lending, something that we're only going to see more and more in the market. The problem with that, though, is that you're dealing with just that particular lender and just that particular lender's safeguards and their asset sheet and their things like that. And what we create is an opportunity to go, hey, we have more investors right now that want our product than we actually have product to put in front of them. So that's the primary reason my job exists, quite frankly. But the reality is we want to expand that secondary marketplace to maybe absorb or be able to exchange other types of assets, because it just doesn't exist. And obviously, Fannie and Freddie are not going to do that. They're the drivers of, and rightly so, but they're the drivers of tradition. And I think the industry and the market certainly is starting to take leaps and bounds beyond tradition. And the industry itself needs to start moving that way. And I think it has been. But Fannie and Freddie is not going to help that. And as much as these different individual lenders can help with things, they're not necessarily creating a robust marketplace that folks know is going to be there and they can participate back and forth. And then there's competition within that marketplace. So you're not just selling it to one person. You have all of these investors looking at that and going, hey, I really love that. I love that book right there, that group of loans. I'll give you this. Whereas, if you were going to sort of a one-stop shop with it, one opportunity, you're like, no, we'll pay you this. And you're stuck with that. So you might not grow that segment as much as you could or should. And all in the long run, all that does is hurt the consumer by eliminating that.
So we haven't touched on, the forgotten technology of 2020, a pre-pandemic blockchain. It's still gonna have its place. It's just a matter of time. So if I remember correctly, because I was actually involved with Figure back in my TPR days when you guys were first starting to do securitizations, and I'll never forget all of the third-party review firms were like didn't know what to do because they were like, there's no fucking paper, and they're so accustomed to like the stare and compare of like, I have to look at paper and I have to review this paper in order to give it a rating agency grade. And all the diligence firms were just like threw their arms up in the air. If I remember correctly, it was Digital Risk that was the first one to kind of step in and say, okay, I think we've got this figured out, from that perspective. But you guys have your own shelf, right? Like you do all your own securitizations, if I remember correctly, right?
We do.
And you said that you allow everyone who's leveraging the platform to then participate in the securitization as well?
They can if that is the partnership level that we establish. We have a few different partnership levels that go as simple as think of a traditional first mortgage wholesale broker type thing, to where you're originating the loan, managing the relationship. It closes in funds in our name. We take on all the risk. We pay you a flat percentage for that loan. It goes all the way up to where, and this is primarily for depositories, although some of the larger IMBs that have lines, that have assets and things like that, they can, but that's where they have the ability to close and retain that asset, and then they can participate in selling that into Figure Connect, or they can group those up, and they can actually participate in one of our securitizations. And really what that comes down to is, one, the ability to hold that on your balance sheet, to have the cash available to fund that and then sit on that. And the other is to have the volume where it's worth it. Obviously if it's just time to go.
Yeah.
We're all waiting for Mace to run off screen.
Hey, I'm sorry, I can't do not disturb in this moment, so people call, it has to come through.
Nope, we're good.
Nothing shuts up Jason quicker than knowing a pregnant wife might be calling. So I haven't been in that position in many years, but so that's really what it is. Sorry.
No. And I mean, it's you all, and then Liquify, who I believe puts Redwood. I haven't caught up with them in a while, but I know they were doing Redwood and Angel Oak securities on blockchain. And this, to me, this is a piece of the industry that just like it boggles my mind that we still have not seen more traction in this. Like, if ever there was a place that blockchain makes all the frigging sense in the world, and that's why I tip my hat to Cagney, in mortgage production and in securities, there is no better place for blockchain. Period. Full stop. You have full disclosure out in terms of what was the data. We know when data changes, right? It's all immutable. I mean, this to me is where the industry as a whole needs to start moving towards. Right now, the one thing that the industry should do, and I remember asking a buddy of mine, we won't name names, is it at a very large investment bank in New York City, maybe on Madison. And I once said, I was like, why don't we do cash flow underwriting? Like, why on God's green earth do we actually do employment and income? Because it makes no sense, right? Because let's say that PK and I make the same amount of money, but PK lives in San Francisco and I live in Fort Wayne, Indiana, and PK's kids go to private school and he eats DoorDash 4 nights a week, right? And my kids are in public school, right? Like, you're just not even. Like, it makes no sense. And the industry could move so much faster if all I had to do was connect to Plaid, and boom, in an instant, it can take the last 24 months of cash flows and completely understand what my actual real DTI is, right?
You can do that now, SSV.
Huh?
You can do that now. You can get single source verification. You have to sign up for it, but
no, I understand that. But there are no mortgage companies necessarily that are doing cash flow underwriting, right? So you're still confirming employment, confirming the income.
And that's And that's exactly it. That's what, and that's what we do. And that's what's really kind of remarkable about it, but also leads to some of my conversations. And I've actually worked it into my talks that, we're not building a 2-year history. We're not creating a 1003 when your borrower or member comes in to apply, because we're doing exactly that with the income. Our income verification process is built around verifying cash flow, to your point. And I think that is fantastic because, one, we don't even ask an employer name. We don't ask your employer name. We don't ask how long you've been there. What we'll do is via the Plaid integration, we're going back. We want to go back at least 6 months. Ideally, we'll go back 12, but we're verifying those deposits coming in. We're looking for consistency. And then depending on, how you listed your employment type, we're going to gross that up per our guidelines, and boom, that becomes your income. And we have other ways of verifying income that can be leveraged as well if there's different incomes. And differing from Fannie or Freddie, we're going to go with the highest one we verify, not with that most conservative lowest one, because we're actually seeing what you're getting. And kind of to your point, you could have 2 borrowers that are the same, but their costs are totally different. And really the only time we see that is in VA lending, where they're looking at things like childcare expenses and stuff like that. But in typical conventional lending, they're not. But they're trusting what is being verified by the paycheck subs, the W-2s, and their underwriters, which is where our entire process, and it goes back to how we verify income and why we look for cash flow, all the way to our blockchain, is our practice of truth over trust. We want the truth over trusting what somebody else says it should be. And as much as I love underwriters there, I've butted heads with them. I've been great friends with them. My Edward Jones guy is a former one from Bank of America. I like them so much now. He was a pain in the ass back then, but who else do I want managing my money but that pain in the ass guy? But the reality is that they're still interpreting it. It's based on their interpretations. And similar to after the loan funds, you're hoping that all the documentation is there. You're hoping that your eyes looking at it are catching everything, seeing everything. Whereas on the front, say like Plaid, it's getting the cash flow. And on the back end, after it funds, our blockchain is that digital ledger that catches everything. You can see everything on that. You don't have to wonder, hey, did I get all the pages? You don't have to have somebody verifying that because it's all there.
Right.
But it's a slow industry. It took a decade probably for people to go from only looking at paper files and underwriting to scrolling on their screen and marking them up there. And I would imagine there's still a handful out there or more that still have to print docs up, write on them, and then re-upload them. When it's like, we've been doing this for a decade. Why do we need paper anything?
Well, and it's so funny to me because like fraud is more possible with paper.
Oh yeah.
With Plaid or Argyle or MX, like we solve that problem like instantaneously, right? But for some reason, the industry does seem hesitant towards moving. And my buddy once said he's like people don't want to know what they don't know. Like that would be the biggest problem is if we actually knew the truth of all of our borrowers, like that could actually be bad for the industry.
They don't want to trust the truth. They want to trust the trust. And that is the issue in our industry. And that's what's absolutely insane. But one of the problems that we're fixing and we're solving for. And it's one of the reasons why our product performs as well as it does. It's an exceptionally well performing product, given that it is a junior lien in many cases. It's because we do that. We go for truth over trust. And it's such a critical piece. And you're looking for that. Why do I care where Jason Smith has been employed over the last 24 months if I can show the actual income that Jason Smith received for 24 months?
The asset's also doing a heavy part of the underwrite here. I mean, that's because you're not looking to pay off a third, you're looking for consistency in the future. And that I understand, I get what you're saying, but like, hey, if I'm doing a 30-year mortgage, I do want to kind of see a little different than the asset.
We do 30-year terms. We go up to a 30-year term and up to a $750,000 loan amount. That's
what I mean is asset's doing a lot of the lifting because the LTV of your loan is not as high, right?
In some degrees, we go up to a max CLTV of 85% on our loan. You're 100% right, and I'm just harassing you a little bit here, but no, there are buffers built in there because it has to be a solid asset for us to be able to originate and sell, maintain for our investors and things like that.
Right.
But we've reduced that risk as much as possible because we've verified from the source and the truth of it as much as possible. Is somebody like a borrower like me, do I still have the potential for default? But I have the potential of not making it to dinner tonight because lightning smites me as soon as I walk out the door. But you have to draw your line somewhere, or you have to live and you have to underwrite as safely and as accurately as possible. And I think that's what we do, and that's why I like what we do, as opposed to making some exceptions because we feel they deserve it. I'm most days a pretty nice guy, but if I'm lending my money out, I want to know the truth. If I want to have an emotional feeling about it, I'm going to loan to a family member or a friend and never expect it back.
All right. So we're getting close to the end here, Jason. So the question that we had from our last guest, which was 2 weeks ago, because I don't even remember why we didn't do last week, but was from Laura K. Shealy over at Watermark TPO. And her question for you was, if you were going to, she's a bestseller 2 times, 2 books. And her question to you was, if you were going to write a book, what would it be about?
It would be about my mistakes, all of my mistakes, because I think that we all want to do the dumb thing, which is learn from our own mistakes. Which, if we learn from other people's mistakes a little bit ahead of time, we could avoid a lot of pain and be a little more efficient ourselves. But I think that's what it is, because you learn more from your mistakes, you learn more from your losses, your misses, than you do from your wins and your good times. And those are what has made me me.
100%. I don't know if you can learn from other people's mistakes, though. They're just not quite as painful, right? And to your point, like with my last company, we had a $250,000 mistake that we made, and that is a mistake I will never forget. I tell every entrepreneur about that mistake, but you're 100% correct, right? That is where all those, and I remember I never understood when I was younger, I would see CEOs of failed companies like get jobs in another company, and I was always like, why the hell you hire that guy? Like, he just bombed over here, right? Or she just bombed over there, or whatever. And then as I got older, I started realizing that I was like, oh, I know why. Because that
You're
person
all the
learned a
mistakes.
lesson that's never going to get repeated, and is probably the best person to now be in that CEO seat. There's something to be said for that experience. Okay, so last but not least, next week we have Sean. What's Sean's last name? I don't know. Sean's Foltz. So we have Sean and Chris, maybe on Chris from Mace Innovations. So what question would you like to ask of Sean, who is the CTO at Mace Innovations?
Let's see. It was kind of stolen the one earlier. The one you asked me, that would have been what I asked. But I would say, because I've been thinking about this a lot recently, is that what was your most personally influential job you ever held, worked, job, role? Because I think we like to think that it's a lot more recent than it actually is, or it's the higher up you get, the more it's impacted you as a person. But I think the reality is we get a lot of our anchoring of who we are fairly early on. And if we're honest with ourselves and look back, we can really see how impactful some of those really poopy jobs were. So yeah, which do you find is your most personally impactful job that you've held?
That's a great question, and I could not agree with you more. Jason, thank you so much appreciate you coming. This has been great. We're gonna have to have you back again to talk more. And it's really funny because PK was like the huge figure fanboy coming into this, and I feel like I'm the one coming out of it. PK, you got me. I'm a full believer. I think there's definitely, it seems like, great things on the horizons for you guys, and look forward to you guys continuing to challenge the industry. So thank you so much.
Yeah.
Well,
Thank
Jason, thank you
Appreciate the
so much. It's a
opportunity.
lot of fun. I took some notes.
Stay on
All right.
after the end of the stream. We can talk about your relationship with Jeffrey Dean Morgan.
I don't know that joke.
Oh my God.
I
The
don't
first
either.
time I had somebody tell me that, I had to look it up real quick. And I turned my phone on. I was like, this dude here? They're like, yeah. I was like, God, I will take that all day long, even with the bat and the barb.
Awesome. All right. Well, ladies and gentlemen, come back next week for Mace Innovations.